Hi, this is Adam Khoo here, and welcome to this final webinar of the year on the 2019 stock market review. So it's 1 week to Christmas and 2 weeks to the end of the year. And I don't know about you, but I found that this year really passed by in a flash. Or is it just that when you're getting older, time passes faster? Anyway, towards the end of every year, I do a review of what has happened for the year in the markets. And before I do that, I think it's important to go back to January 2019 to look at my strategy for the year. So at the beginning of every year, I do a strategy forecast for the year, and I do it every year. So watch out for my January one coming out in 2020. All right, so let's take a quick look at the one I presented in January of this year. Let me just bring it out. All right, so I'm not going to run through the entire forecast all over again. It's going to take 2 hours, so I'm just going to highlight some of the main ideas of my 2019 strategy and how much of it actually played out, how much came true, how much did not come true, because I don't get it right all the time. No one does, all right? All right, so let's go back to that presentation. So what I talked about at the beginning of the year was really about the China stock market opportunity, because at the beginning of the year, China was really undervalued. And it came from a big sell-off that happened back in late 2018 at the start of the US-China trade war. And I said that China presented amazing investment opportunity. US had great opportunity, but China had even bigger opportunity. And the reason is because China was near the bottom of their bear market. Right here at 2744. Right? So I said this was a big bear market where it dropped about 40% because of the trade war as well as the China's slowing economy. And I said that we are right now at the bottom of this bear market and we're going to buy just before the next bull market. As you know, markets are made up of bear markets and bull markets. They don't go up in a straight line. And the time to buy is not during a bull market when people are excited. The time to buy is towards the end of the bear market when people are fearful. Right? To quote Warren Buffett, be fearful when others are greedy and greedy when others are fearful. And the way to make money is to buy when there's blood running on the streets. So in late 2018, there was intense fear about China because China was, slowing down. It's a trade war. People were freaking out. And I said, this is the time to buy because we're at the bottom of the bear market. And again, if you look at the history of China, now, the US stock market has been around for over 227 years. Started in 1782, thereabouts. China's stock market is only about 30 years old and it's really volatile, but if you know when to get in, you can make a lot of money, like what I have. So if you look at the last 24 years, you can see there's a bear market here. The market dropped 61% in the Shanghai index. After the bear market, 61% drop, you've got the bull market 300% up, 32% down, bull market, bear market, bull market, bear market, bull market, and bear market. So again, we were right at the bottom of the bull market going into January 2019. So I said that, I'm going to really start to allocate a lot of my portfolio to China. So just give you an example. Back in 2018, my portfolio was about 90% US, 10% China. Right now, it's about 50% US, 50% China and Asia. So I've made a big shift in my allocation, and the reason is because I want to catch the next bull market up, basically, right? Now, here's the thing. The market dropped 51%, and I said that that's the bottom, okay? How did I know it was the bottom? I looked at the price action of the individual charts of the market. I'll talk about it in a short while. Now, question is, could I have been wrong? Yeah, but I was not wrong. Okay, I'll show you later that I was right. It was the bottom. But even if I was wrong and it dropped a bit more, how much more can it drop? Because normally during a bear market, it has dropped 73% in the past. It has dropped 61% in the past. So it has already dropped 51%, which means my downside is limited. At the very most, it will drop another 10 or 20%. Okay, but once I catch the next bull market, how much would it be? Well, no one knows. But again, based on history, it has gone up 200%, 500%, 300%, 100%. I don't know which it's going to be. But the point is, it's going to go up at least 100% to up to 500%. Which means by getting in right at the bottom of the bear market, I've only got a 10 or 20% more downside for 100 to 500% upside. And that is what I call asymmetrical risk in trading. You're betting $1 to make $2, $3, $4. And you want to buy aggressively in those situations. And that's why in 2019, throughout the year, I accumulated a lot of China companies and China ETFs aggressively while still holding on to my US position. So that was my first call for 2019, and it did play out. We'll look at what happened thereafter in a short while. All right. At the beginning of the year, the PE ratio for the Shanghai index stood at 12 PE. Right, it stood at about 12 PE. Now, to give you some perspective, historically, the PE ratio has been as low as 10, which means we were already near the bottom in January, as high as 70, and the median is 40. Okay, now I don't expect to get back to 70, of course, but I expect that the PE ratio will get back to 40 eventually once the trade war is resolved. All right, so from a PE of 12 to 40, that's about more than 3 times, right? So I expect that whatever I bought in China, I expect it to triple in value in the next couple of years. So that was my first call for 2019. Get aggressive on China and buy the China index ETFs, the Shanghai ETF, the Hang Seng ETF, as well as individual China companies. And I talked about basically 4 main companies I was looking at: Baidu, Alibaba, Tencent, and Ping An Insurance. Right? And out of the 4, I dropped Baidu at the middle of the year. For those of you who've been reading my reports, the reason I dropped it is because from my scuttlebutt. Now, what is scuttlebutt? Scuttlebutt means you got to talk to people who are using the products every day. You got to talk to employees who are working in the companies. And that's the only way to really understand the business. See, many times when you invest in a stock and you only look at the charts or the financial statements, you're looking at what's on the surface. But to understand what's going on deep down inside, to get a first mover advantage, you have to talk to the customers who are using the products every day. You have to talk to the employees who are working in the company, okay? Because when you do that, what happens? You are doing what we call scuttlebutt, which means you're digging out information that is not presented yet in the charts or the financial statements. So when I discovered that many of my friends in China, they said Baidu sucks, right? It's too much ads, a lot of scams, right? We're not using Baidu anymore. And that's why at the middle of the year, I sold Baidu shares. I got out before the crash, thank God, and I used it to buy Meituan Tianping, which later went up 52% since I bought it 4 months ago, because all my friends in China were using Meituan Tianping, their new super app. So you got to understand the customers who are using the products every day. Now, I don't live in China. I have not been to China for many, many years, but I've got close friends who live in China, and they can tell me everything about the Chinese companies. And I share it with all my friends and my subscribers and my students. And that's how we're able to gain an edge over other investors, because we've got people in China using the products every single day. All right. Now, when it comes to Tencent, Alibaba, and Ping An Insurance, these 3 companies did pretty well. And again, we'll look at the performance later on. But these are the 3 main stocks I held on to. Plus, I replaced this with Meituan Tianping at the middle of the year. Now, how about the US? What did I say about the US markets at the beginning of 2019? I said that the US markets were not cheap, but they were not extremely expensive yet, and I'm still holding and I'm still buying a lot. In fact, there were still some companies that were very undervalued that I was buying, like the banks, JP Morgan, Bank of America, Johnson & Johnson, Amazon, Facebook. They were still cheap. Alphabet, Google, still cheap. I was buying a lot of these companies, Microsoft as well, during 2019. Okay. At the beginning of the year, the S&P 500, the PE ratio was 17.73. Remember the figure, 17.73, which is above historical average. So for the last 80 years, the average PE is 15. So anything above 15 PE is expensive, below 15 is cheap. Now, of course, we like to buy when it's really undervalued, but the US markets are not cheap. They are slightly overvalued at 17. But I said, hey, it could go back as high as 30 or 25. In fact, historically, 25 has been the historical high. Once it reaches 25, it gets really expensive. It tends to go back down again. So from 17.7 to 25, we have still got some runway. All right, so I said the US market, I expect it to be bullish this year as well. Now, don't forget that at the end of 2018, the US market was actually in a bear market for a month. It was a mini bear market. Let me just show that to you. There we are. So look at that, right? So this was December 2018, and the US markets went into a bear market where it went below the 200 moving average. The 50 moving average crossed below the 150, and this was scary as shit. So at that point of time, it was, again, the heart of the trade war. China was crashing, the US was crashing, and at that time, people were saying that, hey, it's the start of a big bear market, it's the start of a recession, and they pointed to the yield curve, saying that the yield curve has inverted, and it's a signal for recession. Now, what did I say? I said that, yes, the US market is in a bear market, but in a strong economy. There's divergence. Because we have got remarkable S&P 500 earnings growth, right? Company earnings were still growing strong and projected to continue growing strong. The bear market, I said, was primarily psychological. Fear over the uncertainty of the trade war, Brexit, flattening yield curve. I said economic fundamentals are still strong. Employment is growing, manufacturing is growing. At the same time, I said the current bear market is unlikely to lead. Here's what I said. The current bear market is unlikely to lead to a recession and presents an opportunity to buy great companies at huge discounts. However, it is at a late stage of the economic cycle. So what were the stocks I was buying? I've got a preference for stocks in technology, communications, and financials. My favorites were Microsoft, Adobe, Salesforce, and Applied Materials. Facebook, Alphabet, Netflix, JP Morgan, as well as BlackRock. Now, I must say that throughout during the mid of the year, I did sell my BlackRock for a small profit, but I held on to the rest. I never bought Netflix, by the way. I bought everything else. Okay? And what happened? Sure enough, the bear market that everyone thought would lead to a recession did not. In fact, it only lasted for a month. After falling 20%, the bear market reversed back into the bull market. And that's how I had a pretty good return on my portfolio by holding on and adding more shares right at the bottom over there. Okay, if you remember, Facebook was also going through a lot of problems. Zuckerberg went to Congress and got grilled for the data leak in basically they're selling data to the wrong parties, basically, right? And I said that Facebook's a great opportunity. I'm buying Facebook at a huge discount. My valuation for Facebook was about $207. But right now, I've raised my valuation to $250, and I bought it at a huge discount at about I think I bought it at about $150, right? And Facebook has gone up quite a bit since then. I also talked about Johnson & Johnson after it plunged 10% because of the problems with asbestos in baby powder, right? So J&J plunged to $129. I started buying really cheap, and right now it's at a really, really high price. Again, J&J is up about, I'll check it out later. Let me see how much it's up so far. J&J, since I bought it, let me check it out. There we go, right? Yeah, so since I bought it at a support level, it's gone up from $127 to $144. Pretty good return. Let me see what's return. Yeah, well, 11% in just a couple of months, J&J, right? And again, this came out in my January report, but I started entering at the support level over there. All right, so these were my summary of opportunities for 2019. What did I say? I said that the current bear market in US stocks is unlikely to lead to a recession and offers value investors an opportunity to buy great companies at huge discounts. Was I right on that? Yep, I was. Okay. The US economy is at the late stage cycle, best to focus on high quality, good companies that are less economically sensitive. Example, Adobe, Microsoft, Google, and Facebook. How did these stocks do? Let's take a look. So first of all, Adobe for the year. Let's look at how it did for the year. For the last 1 year. So Adobe, you can see, is up from $210 to $325. It tripled in 2019. So that was a great call. Next, Microsoft, one of my core holdings as well. Microsoft, there we go. It started a year at $90. It's now $155. So again, that's about almost an 80% return for the year for Microsoft. Alphabet, Google, right? My call in January, it was at $1,000. Now it's at $1,300. So there's 30% return for Alphabet as well. All right. And I also talked about Facebook. Yeah, Facebook. How could I forget Facebook? My core holding as well. As you can see, Facebook was in the shithole at $120. Right now, it hit a high of $200, so it almost a 90% return over there. Consolidated, and now we're at 198. So about 80% return for the year as well. All right. So all that worked out for me pretty well. What else did I say? Okay. My favorite sectors were communications, technology, and finance, all of which have outperformed the markets this year. China is the long-term world growth leader, is undervalued, and so I was buying the China ETFs like GXC, FXI, and EWH. I talked a bit about Singapore and Malaysia, and I said that they were not going to do very well. Long-term growth potential is low, and indeed, they did not do as well as before. I also used the opportunity to buy a lot of REITs as well. Right, so those were my main calls for the year. So what happened at the end? What was the result? So again, let's take a look. So the S&P 500, let's go to year to date. Yeah. Started the year at the bottom of the bear market at 2346. We're now at 3198. So the S&P 500 is up about 26% for the year. All right, so it's been a pretty bullish year. The Dow Jones is up slightly less. It's up about 21% for the year. Okay, now how did China do? Let's look at China. So for China, basically, I look at two markets. The first would be the Shanghai Composite Index. Okay, so Shanghai started the year here at about 2004, and now we're at 3017. So China ended the year up about, let me see, 19%. All right, so this is one thing I got wrong. I expected China to outperform the US this year, but the US still outperformed China, right? So the US is up 26%, China is up 19%. But it's okay, I got it wrong, but I'm again 50-50 in both, so it doesn't really matter to me, right? I've got an equal allocation to US, China, and Asian stocks. But I really do expect that in 2020, right, China and Asia will outperform the US. And let's see if I'm right next year, okay? Now, I was equally bullish on the Shanghai index and the Hong Kong Hang Seng index at the beginning of the year. What I did not see, I did not predict, was the riots that unfolded in Hong Kong. It's something that I never foresaw, and it's still going on. And so when that happened, I started to allocate more resources to Shanghai as compared to Hong Kong. But despite all the riots, Hong Kong is still up. All right, if you check it out, interestingly enough, despite all the problems that Hong Kong has been having, and they will be resolved eventually, right? They will be resolved, right? How, I don't know, but it will be resolved. It still ended up the year from here to here, right? So Hong Kong is still up 7.7% return for the year. Not as great as I wanted, but still not bad. Now, the great thing is that, you see, in the Hong Kong stock market, in the Hang Seng index, half the companies are China companies where they sell to China. And the other half are Hong Kong companies where they sell primarily to the Hong Kong consumers, right? And for me, I only buy companies that sell to the China market. Why? Because it's a much bigger market than Hong Kong. So I buy China companies that sell to China in the world, but are listed on the Hong Kong market. So even though Hong Kong had all the problems, but the companies I bought, like Tencent, like Alibaba, like Meituan Dianping, they all went up double digits because they are Chinese companies, primarily selling to the mainland China as well as to the rest of the world, and not confined to just the Hong Kong markets. Now, the interesting thing is that although the S&P 500 is up 26.4% year to date, and the Shanghai market is up 19% year to date, but the whole year has been nothing but bad news, if you remember, right? Almost every single month, there was tremendous bad news in the mainstream media, from the Brexit uncertainty to the US-China trade war, Trump's tweeting, right, slowing China GDP, the yield curve inversion signaling a recession, the Hong Kong unrest. So it's all the bad news. And so there's one thing you have to understand about the markets. Bull markets tend to climb a wall of worry. In other words, I can tell you that after being in the markets for 28 years, I found that every time the media tells you it's really bad news, doomsday, the market keeps going higher. But once the media tells you that everything is great, that's when the market crashes. So bulls always climb a wall of worry, and bears slide down a slippery slope of hope, right? Remember that saying. Now, and again, the mainstream news was all about fear this year, right? Like back in October, they said that awfully high risk of global recession in the next 12 to 18 months. They were saying things like the father of the yield curve says now is the time to prepare for recession. This was back again in October, right? And a lot of these economists were saying it's time to start shorting the S&P 500. And all this was back in August to October when the yield curve was signaling a recession, somewhere about there. So if you listen to all these people, all these experts and economists and news, what's going to happen, right? When it drops over here, you're going to panic and start selling. And once you sell, what happens? That's right, it goes higher. So that's why retail investors always get screwed by the rigged system, right? Because the rigged system will tell them to always sell at the lowest point. And after they sell, the market goes up. Once it goes up, it'll tell them to buy. Once they buy, it'll crash again. And that's why the retail investors will never, ever make money. That's why in the markets, it's always 90% of the people who will lose all the money to the 10% who will make all the money. Now, some people may hate me and say, hey, you're a bastard taking my money. Let me tell you something. Don't hate the player. Hate the game. But the game is rigged. But if you want to be a player that makes money from this game, you have to understand that you never make investment decisions based on reading the mainstream news. You never make investment decisions based on emotions like fear and greed. You never make investment decisions by listening to the opinions of all these experts, economists or analysts. The only way to make money is to think independently. The only way to make money is to make investment decisions of buying and selling based on, number one, fundamental research. You have to do the research of the companies that you're buying. Remember, when you're buying a stock, you're not buying a lottery ticket. You're buying a part ownership of a business. You got to understand the business. You got to understand, are the sales, earnings growing? Does the company have a strong business model that gives it a wide economic moat? Do they have growth drivers? All right. Is the company overvalued or undervalued? This is what is important, not Brexit and not the trade war. All those are merely noise and distractions meant to screw you up. You got to look at the fundamentals of the company. Next, scuttlebutt. I make decisions based on, again, like I said, talking to employees of the company, asking them, hey, how's your company doing? I talk to the customers. Are you still buying the product every single day? I talk to competitors to find out what they think about my company. The next thing is you got to look at technical analysis. You got to look at the trends. Is it an uptrend or a downtrend? Is it at a resistance or support level? You got to look at price action. So my decisions on whether to buy or sell every single day is based on fundamentals, technicals, and scuttlebutt. At the same time, I also keep an eye on the macro picture. I look at market cycles, right? Market cycles are driven by interest rates. Is the whole market on an uptrend or is the whole market on a downtrend? I look at secular growth trends. There are certain industries that are growing because of certain trends, like healthcare from an aging global population, 5G technology, cloud computing, marijuana being legal in the US, robotics, cybersecurity. So when you buy companies that position themselves within these trends, you make a lot of money. And I'll talk a lot about it in my coming premium newsletter reports that I'll be sharing with you later in this webinar. Next, you got to look at macroeconomic drivers as well. Things like the political cycle, the interest rate cycle. In fact, let me just show you one of my reports that I wrote. And these are monthly reports. This is not the premium report. This is just the basic Mickey Mouse report, right? The premium report will blow your mind away. Now, this was back in May. All right, this was my May report. And what did I say in May? Right? Oops, sorry. Yeah. I said there are two reasons that the bull market is likely to continue. Now, to jog your memory, remember what happened in May. All right, in May, over here, we had this big drop. So people freaking, oh my God, we're going to die. And I say, hey, hold on. We're going to die. We're going to end up the year much higher. And the reason I knew was because I was watching the US presidential cycle. I said that there are two reasons the bull market is going to continue. Number one, 12 months after the US midterm elections and the third year of the presidential US term have been the most bullish historically. So you're going to look at what we call cycles. For example, look at this chart over here. There we go. So this is the first year of the new presidential term, which was 2016 for Trump's administration, 2017. Oh, sorry, my bad. 2017 was here. 2016 was the elections, right? 2017 is the first year of the Trump administration, second year, third year, and fourth year. And historically, since 1928, the most bullish year has been the third year of the presidential term. And this is the third year, 2019. So I said, this year we're going to be bullish because of the third year cycle. So you got to understand the third year cycle, really important, right? And I said, reason number two, why I'm bullish is because the majority of investors are fearful and pessimistic. Remember, when everyone is scared, the market tends to go up. When everyone is excited, the market tends to crash. The market tends to always go opposite of what the general public thinks. And at that time, in May, when everyone was saying that the market's going to go to shit, I said, I'm buying right now. So when you go opposite of the crowd, of the herd, that's how you make money. Always remember this, guys. 90% of people will lose money in their investments. 90%. And only 10% will make money. So if you want to be the ones to make money, you have to follow the minority and ignore the majority. It has worked for me for 28 years. And I guide my students to follow this philosophy every month, every week, every day, every year. And that's how we beat the markets. So this year has been pretty bullish. Like I said, the S&P is up 26%. My goal has been to beat the markets every year. And I've beaten the markets almost every single year for the last 28 years. And I'm thankful to have beaten it again this year. All right. So this is one of my accounts. I've got several accounts that I manage for myself and for my family. It's one of my accounts. And you can see that I'm using Interactive Brokers, one of the many brokers I use. So year to date, all right, you can see I'm up so far for the year, 45% for the year. All right, beating the S&P 500 of 26%. Another account I can show you would be, it's another account I'm managing. Yeah, this one, right? So this account, I only funded it with Interactive Brokers in May, right? If you look at since inception over here. All right, so I only started in May with IB, and it's up about 15% for the last 6 months. About 7 months, right? So annualized is about 25% annualized, because this 15% return is just for about 6 to 7 months. And the reason is because I transferred all these funds from another broker, which I'm not going to use anymore. I won't mention which broker, but because their customer service sucks, so I transferred all my funds to IB into this new account, right? In fact, from that broker, I actually started with about $100,000 in that broker, and I grew it to now almost 700,000 over the last 5.5 years. All right. So again, I don't say I can, double my account every year. Some years you get 20%, some years 30%, some years 40%, some years 70. But if you compound it, you can really, really build your wealth with your account, right? So what were some of the great opportunities that helped me to drive my account value up this year, right? And there were many of them, and I share many of them in my monthly reports with my students, the basic reports, and more importantly, my upcoming premium report known as the Ultimate Investors Playbook, which I'll talk about towards the end of the webinar, and a chance for you to grab this very powerful report that will come out once a month, where I talk about exactly what stocks I'm looking at, what stocks I'm buying, and what stocks I'm selling, all right? And it's available for anyone who wants to purchase this premium Ultimate Investors Playbook, all right? So let's take a look at some of the opportunities for the year, and I'll share with you some of my previous reports. One of them was back in August. All right, so you can see this was my August report. And again, as always, my disclaimer is I'm not a licensed financial advisor. So I do not give financial advice and recommendations. I never tell people what to buy or what to sell. I only tell you what I'm buying and what I'm selling. Okay? So I only share this for educational purposes, but before you buy and sell a stock, always do your own research. Always seek advice from a licensed financial advisor, because I'm not licensed. All right? I'm just a professional investor who manages my own money and no one else's money, my family and my money, and I'm just sharing what I do for the benefit of people's education. So that's my disclaimer, all right? And so back in August, some of my key things I talked about was Microsoft, right? So I say if you look at Microsoft, you can see that, it's finding support at the moving averages, exactly when I would add Microsoft. And Microsoft is up almost 100% this year, as you saw earlier on. The other one was Johnson & Johnson, which was in my report back in August. So I said that, hey, I'm getting in at these support levels over there, right? So always buy at the support levels of a consolidation pattern. And now, as you can see, J&J for the year is up to a new high right there, right at the support level, right? So I take advantage of technical analysis and looking at the fundamentals. Really, really important. right? The other thing which I entered was Domino's Pizza. This was also in my August report. You can see Domino's was at a very strong support level. So I started buying Domino's at about 244, Domino's Pizza, right? And now it's already recovered. Let's see where Domino's is right now. Yeah. So from 244, which was my entry price, thereabouts 244, is now at 291. And it's right now at the previous resistance. So would be a good time to take some profits, right? Before it comes back down again. It could, but I'm buying some put options and selling covered calls and holding on to the stock. That's another way to hedge my portfolio. All right, so that is the August report. So you can see that in just one report, I had 3 great investment opportunities that made a lot of money in just 1 month report. Okay. All right, and my September report was also really interesting because in my September report, I said that banks are very cheap. So I was buying the banks, JP Morgan, Bank of America, because of the historically low interest rates at the time. I was buying the banks, and let's see what has happened to the banks since then, since my September report, right? So since September, right, you can see that JP Morgan, it went down, it hit the 200 moving average. It was very undervalued, and I started buying aggressively at about $105, and right now it's up 40%. Well, it's up 40% for the year, but it's up about 20% since my second entry, because I was holding it since last year as well. So overall up 40% for the year. Bank of America, that I also accumulated, as you can see, back in September, I added more shares at the support level, at a very strong support. Every time it hits support, I will add more shares. Right now, up $35 from 26, again up about 25% from there, and for the year it's up almost 40%. So that was in the September report. All right. Now in September, I also talked about the bond ETF, and I said bonds are in a bubble waiting to burst. And I said that I'm shorting the bond ETF, right? So we short the bond ETF by buying put options or by shorting the bond ETF directly. All right, and what has happened since then? It has indeed come down. There we go. So this was my September report. I said bonds are overvalued. It's in a bubble. Short bonds, boom, it's down. All right. Now again, don't get me wrong. I'm not able to anticipate anything 100%. I don't get it right all the time. Okay. I only get it right more than half the time. So there are times I get it wrong. Okay, so for example, on GE, General Electric, I was bearish, I was shorting the stock. I thought it would go down, but the bastard never went down. It went up instead. So when it went up, I quickly cut my losses, so I took a small loss on GE. So the important thing is not to be right all the time. No one can be right all the time. You just have to be right more than you're wrong, and make more when you're right, and lose less when you're wrong, and that's how you make great profits every single year. All right. So that was in my September report. What else did I talk about? Yes, of course. Meituan Tianping. This was the China stock that I started buying back in September, and I bought it. My buy price, after I did my research, there it was. Yeah. So my buy price at the time, I said, hey, there's a resistance support. So I'm aiming to buy at $70 over there. I would prefer to start adding shares at $70. Right? So I bought this in September. Since then, it has gone up from $70 over here to $103. So 40% return, 50% return in just 4 months. So this replaced my Baidu shares that I sold when all my friends in China told me it was a crap company. Right? So the more I sold it, I reallocated the shares to Meituan Tianping, made 50% return in 4 months. And again, all these are in my monthly reports. And again, stay tuned, because at the end of the webinar, I'll share with you how you can get my monthly reports, as well as, again, a premium report known as the Ultimate Investors Playbook. And if you think this is good, that would blow your freaking mind. Right? So this was my September report. And October, this was my October report. I talked about the health insurance industry, because Elizabeth Warren, who is a Democratic frontrunner, she's against private health insurance. So the moment she started leading in the polls, well, she didn't lead, sorry. The moment she started gaining in the polls against Joe Biden, people freaked out and sold all the health insurance companies. So this stock, United Health, right, it dropped all the way down to the support level, and I started buying this at 217. That's right. So where is it right now? It's recovered since then from 217. It's up 295. That's right. So I bought it here at the support level, and it's up 34% since I bought it. So this was another great opportunity that came out in the October report. And I also talked about this ETF, right? This one, which is the IHF. This is the health insurance ETF. And you can see a strong support at the 150. It dropped and hit the support. I started buying at 161. That's right. I bought it at 161. This was back in October. And in 2 months, see what happened. Here we go, right? So my entry was at this 150 moving average on the weekly candles. I bought it here. Now it's up here. It's up about 23% in just 2 months. In fact, a month and a half, right? So 23% in a month and a half. Great opportunity. And this was in my October report, right? So on and so forth. So you can see that in one report, one idea makes me so much money, all right? And I share these ideas, again, not as advice, not as recommendations, but as education. And I make sure that, my subscribers are able to benefit from the best education possible every single month. Now, those of you who are in my investment inner circle, you know that my ability to pick great companies and great stocks at the right time, it does not happen by chance. It takes a tremendous amount of hard work and experience to pull this off every single year. And let me just say that anyone can succeed in the markets. But again, it takes hours and hours of hard work. You gotta first accumulate the knowledge of knowing how to analyze businesses, fundamental analysis. You must be a master at reading charts, technical analysis, and to also understand macroeconomic analysis as well. And once you understand that, you must be able to do research before you buy a stock. You must be able to execute your research and to track your portfolios and your investments regularly. See, a lot of people, they look at me and say, hey, you've got a great life. All you do is sit around and talk and click a button and you make, hundreds of thousands of dollars all the time. But what they don't see is before that click of the mouse, before I sit down and press that button, they don't see the hours and hours of hard work that is put into that. They don't see that. They just see that click, all right? So let me just tell you that before I click a buy or sell, what goes on behind that? And here's just a very, very quick summary, right? So before I make every buy or sell decision, the first thing I do is I spend up to 6 to 10 hours doing intensive research into the company's financial statements, its business model, its technical patterns, and I go back through years and years of data, sometimes even up to 10 to 20 years of financial data. To do that, I subscribe to a whole range of research tools in the markets, like professional screening and research tools from Bloomberg, from S&P Capital IQ, and many others. And in total, in a year, I invest about $50,000 in subscription fees to get all these professional equipment and software to get the data. At the same time, I watch my favorite companies for months. Once I like a company, I don't buy it immediately. I watch it every single day, week, and month for the right time, for the price to be undervalued at the right support level, and I strike. And once I buy it, that's not all. I then watch the price action every day to know, hey, is it time to get out? Is it time to add more shares? Do I have to protect my portfolio using options and using inverse ETFs? And even before I do all that, I gotta first have the knowledge and the experience. Okay? So let me tell you that besides spending 3 years in business school majoring in finance, I also read, since I was 17, I also read over 600 books on accounting, economics, fundamental analysis, technical analysis, behavioral finance, and any book that has got to do with the markets. I've spent the last 28 years, since I was 17 years old, I'm now 45, right? I spent the last 28 years watching the live markets every day for about 2-3 hours every single day. So if you do the math, that's about 19,000 hours I've been watching the markets. Now, let me tell you that if anyone has spent 19,000 hours watching the markets, it's hard not to be good at the markets, all right? At the same time, I've spent, again, the last 28 years reading financial reports of companies, reading their technical charts, drawing all those lines for at least 2 to 3 hours a day, every day for 28 years. So add another 19,000 hours to that, okay? So question is, what is the price you would put on all this experience and all this hard work? What's the price? Now, I'm gonna be honest with you, I've got no idea what price to put, but it's not a low price. See, everyone wants to succeed, but very few people are willing to pay the price necessary to be the best in the business, necessary to be successful and wealthy. Now, I'm not saying all this to impress you, but to really drive home the point that there is no free lunch in this world. There is no free money. Because if it was that easy, everyone would become a multi-millionaire. Everyone would be sitting at home earning passive income. It is not easy. The only way to succeed and build your wealth is if you're committed to put in the hard work, the time, and the energy. If you're committed to pay the price. Now, am I saying that to achieve the same success, you have to go to 3 years of business school, you have to spend 40,000 hours watching the markets, reading financial reports? Am I saying you're going to do all this to succeed? The answer is you could, right? But you don't have to, right? Why? Here's the good news. How could you catch up with professionals like me who have spent decades mastering the markets, mastering companies? And how can you massively cut short your learning curve? So what it takes people 28 years to pull off, you can pull off in a couple of months. And I've got a solution for you. And this is what inspired me to create this brand new product for my students, for my subscribers. And this new product is called the Ultimate Investor's Playbook. So this is a premium report that I write with my research team every single month, where we highlight the best asymmetrical investment opportunities in today's global markets. And again, what is the meaning of asymmetrical? Which means I only look for opportunities where we've got tremendous returns for very low risk or capital. And we're going to be focusing on both the US as well as China and some Asian markets as well. Now, my personal allocation in investments is about currently 50% the US, 50% China and Asia. But China and Asia could increase in time to come. Now, when I say this, there are some people, for example, from the West, from the US, they may say, hey, but China's a communist country, you'll take over the companies, it's going to be dangerous. Hey, you've been fed all this bullshit by the media. And if you don't invest in China, you're going to be missing out on one of the greatest growth engines of the next 20 to 50 years. Now, I love the US. I use US products, I invest in US markets, but you can't ignore China. And here's the great news. Whether you're from the US, from Europe, from Asia, from Africa, anyone can invest in Chinese stocks, US stocks, if you know how, using the power of the internet, online trading, online investing. So you're going to be learning about how to do all that through these courses and newsletters. And you'll be focusing not just on stocks per se, but also on ETFs as well as other asset classes. So if I see an opportunity in gold, if I see an opportunity in bonds, if I see an opportunity in currencies, you'll be the first to know in this report as well, because whatever I put my money into, I'll talk about in these reports. So what kind of opportunities do I put my money into? What kind of stocks do I buy? And the answer is I buy all kinds of stocks as long as I see a great opportunity. So in this premium report, I'll talk about the different kind of stocks that would come up from time to time. For example, there are times when I'll put my money into large cap growth companies that grow beyond 25% a year that dominate their industry. There are also times when I'll buy large cap predictable companies like Johnson & Johnson or McDonald's, really safe companies but selling at huge discounts because of temporary bad news in the markets. And I can make money really fast even if they're really safe companies. I also look for companies that are selling at a very undervalued price. We call them deep value stocks. So there are certain times when there's a industry recession where certain companies, their share price is selling below their net liquidation value or their cash value per share, which means even if the company closes down and sells and liquidates everything and say you get $1 back, you can buy that stock for 50 cents. And it's happening in some markets like Hong Kong right now. So these are some great opportunities that we'll also be looking at. Next, there are times when I also invest in companies for great dividends, especially REITs, real estate investment trusts. When they do come up, these are the things you're going to learn as well. I also go from time to time into speculative growth stocks. So these are companies that have not yet dominated their industry, but they could potentially become large companies, but they're just growing. They're at their very early phase of growth, like Meituan Tianping or possibly Zoom Communications. We call this speculative growth stocks. Finally, I also look at secular growth industries. Like I said, 5G, cybersecurity, cloud computing. And how do we select the right ETFs to ride on these strong waves of growth in the years to come? All right. There are also times when certain industries are at huge discounts. For example, the health insurance industry, which I mentioned in my earlier report, right? Because of the presidential elections, health insurance stocks took a big beating. Bank stocks were really undervalued in the last 4 months. So we'll also look at really undervalued industries and how do we ride on them using ETFs as well. So again, we'll be looking at anything that makes money with low risk and low cost. So for any kind of stock which I'm watching and I'm investing in, I will highlight it into this premium report. And for every stock, I'll share with you my detailed analysis of how I analyze the company's business model, its competitive advantage against its competition, its performance track record, as well as how I value these companies to know whether it's undervalued or overvalued. I'll also show you how I read the technical chart patterns to identify the exact points when I'm accumulating the shares or when I'm be selling the shares, where I analyze the trend, the support and resistance levels using candlestick patterns, price action. I will also incorporate and show you how I make use of secular growth trends, like looking again at market cycles, macroeconomics, interest rates, and also the scuttlebutt approach to investing, which means we'll take a look at how I talk to the customers of these companies, even the competitors, and sometimes even the employees. So all these things go into an investment opportunity, whether it's stocks or REITs or ETFs. And again, these could be, again, companies like Apple, which are growth companies, or Amazon, or speculative companies like Roku, or Alibaba, China companies, US companies, Asian companies. We'll look at anything globally, worldwide, there's a great opportunity. Now, once these great companies or ETFs are highlighted in the report, they'll be placed into our Ultimate Investors watch list. So as a subscriber, you will also get access to this watch list that you can watch every single day, ready to pull the trigger, all right? And the moment a stock is at the right point to buy or to sell, okay, I will start buying it. I'll start selling it. and this will be highlighted in our Ultimate Investors portfolio. So once I buy a stock, it'll be included into the portfolio, and you will get an email notification telling you, hey, Adam's buying this stock, Adam's selling this stock. This stock has been included into the watch list. And again, let me emphasize once again, this is not an advisory, or not a recommendation service. These are only shared for educational purposes to show you how I manage my portfolio. Everyone has different financial objectives and different risk and return profile. So please do your own research and make your own decisions before making any investment decisions. Okay, let me just make that disclaimer really clear right here. Now, there will also be an Ultimate Investors private forum where you get to join this private forum to clarify your questions, get your questions answered, and contribute additional insight into our stock analysis. So we get a collective contribution from everyone out there who could be experts in certain industries. At times, I'll also invite industry experts and even customers to talk about the companies of the stocks that we are looking at. So we get really inside knowledge in each investment. And this is something that no other newsletter or report service will provide. So it's something that's really unique to the Ultimate Investors Playbook. And I do hope that you grab this opportunity to be part of our exclusive community. So guys, if you're serious about getting a practical financial education, if you're serious about getting the best investment opportunities delivered to you every single month, this Investors Playbook is a no-brainer must-have. Now, I've looked at a lot of other premium investment newsletters in the markets, and many of them are selling for anywhere between $1,500 to $5,000 a year. And some of them are not bad, some of them are pretty good. But I can tell you that they do not have the width and the depth of content that you're going to get from the Ultimate Investors Playbook. And 99% of these other newsletters are written by professional analysts and academics who do not have skin in the game. In other words, they do not actually put in money in whatever stocks they are recommending in their newsletter. The difference is, in this monthly premium newsletter, I only highlight stocks that I am watching and I'm putting my money in. So I've got skin in the game. Now, not only are these valuable investment ideas monthly going to be worth thousands or hundreds of thousands worth of potential profit to you, but think of the thousands of research hours you're going to save. Think of how fast you're going to shorten and accelerate your learning curve with this exclusive playbook that you're going to get every single month. Alright, so this is an annual subscription that includes 12 monthly premium reports written by my team and I, delivered to you at the beginning of every month. You get a minimum of 2 great investment ideas per month, sometimes even more, all right? And for every idea, in-depth analysis on how I analyze the company, how I analyze the industry with fundamentals, technicals, macroeconomics, and cycles and growth patterns. Now, in addition, you also get access to our private forum, which is attached to each investment idea, where you get all your questions answered and where different members can contribute to the forum as well. And like I said, we'll also invite at times industry experts to share valuable insider secrets to those investments. You'll also be getting our investment portfolio and watch list. They'll be updated live and you'll be sent alerts whenever a new stock is included in the watch list and in the portfolio. So this is worth, hundreds of thousands or millions of dollars worth of potential value. And you can grab it for only $1,800 per year. It's the retail price going out to the general public. Now, great news. We are offering our subscribers, our students, a pre-order special where you get to subscribe at 60% off before the first issue goes out on the 1st of February 2020, right? So again, the first issue will be going out in February 2020 and you can pre-order for 60% discount for next year's subscription at only $720. And that works out to be only $60 per month. And you saw earlier on that in a month, it's just one great idea can make you thousands or even hundreds of thousands of dollars. So this is a very, very low investment for tremendous valuable knowledge. So I do hope you grab this opportunity. At the same time, for our Christmas gift to our students, you'll also be getting 65% off all our courses. Our stock investment course, our stock trading course, our forex trading course, our options trading course, and our cryptocurrency course, all at piranhaprofits.com. And this will be the last offer for a long time to come. So again, 65% off. Go to our website or click right here, right, to subscribe to the Ultimate Investors Playbook or to any of the courses at this crazy, crazy Christmas discount. So with that, Merry Christmas, have a Happy New Year. May the markets be with you for the coming years ahead. I'll see you soon, guys.